You heard who is on our panel, but I was saying we have a great mix because everyone overlaps in some ways, but we have a lot of differences. Katie is our quant guru with CTA AlphaSimplex, and Marc is with the non-traditional group, so he knows about every kind of bond, you name it, and Gemma knows about all the bonds too, but she does a lot with treasuries. So I'm going to try to bring out the best in everyone. So we're going to start with, which is the main focus of our panel, is we've seen treasury yields all across the globe just tumble. I mean, we have the 10-year treasury yield at a little over 2%. A few months ago, it was half a percentage point higher. Last year was at 3.25. So we're going to start with that. We also have bond yields that touch record negative lows. So we're going to start with, I know we've had a lot of panelists already talk a little bit about rates. So I want to come to each of you and ask you, number one, what do you make of this? Does it make sense where yields are? Kind of some thoughts on where do you see going forward? And Katie, I know you run a lot by model, so we'll try to angle our questions for you that way. But I think I'll start with Gemma, if you want to speak to this big fall in yields.
Yeah, I mean, I think our view of Vanguard right along over the last few years has been that there are structural forces that will keep interest rates lower than otherwise. And so at 3.25, we thought they looked fairly attractive given very low levels of inflation. Inflation has continued to disappoint, so that's depressed inflation premia. Then you've mixed into it, as other panelists have spoken about today, the uncertainty with respect to global growth. You have global central banks, very accommodative. You have the ECB, the Bank of Japan, China providing stimulus against the trade, and now the Fed basically pivoting in the first quarter of this year. And so there's a synchronized policy move again, where the central banks are easy. So we're not necessarily surprised that rates have fallen. I think 2% of the 10-year yield is a little breathtaking, but it really tells you how much the market is really forward-looking and beginning to price in a series of interest rate cuts predicated upon inflation missing the Fed's target and the risk of a more significant global slowdown because of the trade uncertainties.
Now, Marc, I think I'll go to you with that and add what you like, but also, do you think this pricing in makes sense, or where do you think yields going forward from here?
So, Liz, your question, does it make sense? I think it does make sense. And I'll give you three lenses by which to look through to justify it making sense. First of all, the market gets wrapped around sort of the near-term pricing of 2 or 3 rate cuts by end of 2019, early 2020. That's probably the wrong way of looking at it, or that is perhaps the wrong way of looking at it. I think what one should think about is, given that we are so late in an economic cycle, what's the possibility of an economic downturn over some secular time horizon, call it 3 to 5 years? What policy ammunition is left in terms of fiscal or monetary policy to right an economic correction? And therefore, how quickly will rates go to zero again next time, next cycle? And if your answer is it's likely and it may happen sooner rather than later, then you can justify not just these yield levels, but lower yield levels. The second lens would be, there was a lot of romancing in markets last year about sort of the breakdown in correlations and whether or not treasuries and high quality bonds generally can act as a diversifier in a broader asset allocation. Well, I think what we learned in the fourth quarter of last year, and what we're certainly learning this month and over the past month, is absolutely treasuries can still act as the diversifier. Not just treasuries, but high quality bonds can act as the diversifier against a broader asset allocation. So there's an insurance value to owning treasuries. And then the third lens, Liz, you mentioned this, German bond yields are minus 21 basis points. So you give money to the German government and they guarantee giving you less than your money back after 10 years. I don't know, 211 seems low for a 10-year treasury yield, but I'd rather give money to the US Treasury to watch and safeguard and get at least a little bit of a return back versus a negative return. So that makes sense. That said, 2-year treasuries, 3-year treasuries around 180 versus 3-month T-bills at 220 or 230. I think this may be a little bit ahead of itself, but I do think on a longer term basis you can justify much lower yields.
So before I go to you, Katie, can I push you a little? 10-year can go lower, like where?
Let's use some simple math. So let's say, so the 10-year discounts the next 3,650 days of where short-term interest rates will be, right? So that's what it discounts. Let's say You spend 5 years around 240, and let's say you spend 5 years, again, over the next 10 years, around 0. That's not a crazy scenario. That means that you could justify a 10-year Treasury yield around 1.25%. Add some term premium, 1.5%, 1.6%, wouldn't shock me.
Okay, great. And Katie, I want to hear your thoughts in your models. And I was saying Katie has a degree in engineering and operations research PhD, right? Is that right? So tell us how, in your modeling, what are you guys doing? You know, what's your thoughts on? And Marc mentioned correlation. I know you look at a lot of that. So
it's interesting because the way that we think about markets is about measuring where they're going. So a year ago, I was sitting here thinking short bonds, which is really odd because of where we're sitting today. And around Q4 last year, everything changed. And one of the things that was really interesting, you asked the question, what's driving this plunge? We are seeing two things in the way that we look at markets. First, we're seeing a clear reversion to the mean. The US behaved substantially differently last year. Not just bonds, US equities behaved differently, US bonds behaved differently, and we all know the dollar behaved differently. So the US was somewhat out of sync. And so in that sense, there's these natural forces which are pulling us back to some sense towards other markets. Now think about how many times in history you've seen the US dollar as a positive carry currency. We had a much higher rate. So having a 2% yield may sound boring to us, but believe me, if you talk to my friends in Sweden, they would be very excited about that. So the first force is obviously a reversion to the mean, and we're seeing that in prices, we're seeing that in trends. But the second, and this has been very poignant in the spring, is flight to safety. And we're seeing massive moves across asset classes that we didn't see last year when we saw a lot of short pressure on bonds. And what we're seeing is, in simultaneous days, we're seeing massive downturns in equities coupled with increases in bonds, coupled with increases in the dollar. Last week, it actually changed us a little bit. So I might want to talk about that a little bit later, because that trade has been very interesting to watch these forces just pulling in different directions. And so we do this by looking at sort of the trends and using mathematical techniques, but we're really following that. And that's been the theme that we've really seen this spring. So we see a lot of indication which would agree with Marc.
And so it's a good time, you know, for trend following and momentum models and all that you do. It's not boring, you know. You have a lot to.
Never boring.
Never boring. right.
There's always a trend somewhere.
Yeah.
So, yeah.
That's good. Well, we can't talk about yields if we don't. And my father, who's, I'll date myself, 80-something, and a GE company man, really is a stock guy. But he'll call me now and say, hey, Liz, what's this inverted yield curve thing, you know? And so I have to ask you guys, there's a lot of differing views. We have the 3-month 10-year, which is, you know, kind of the San Francisco Fed's baby. They say that's the one to look at. A lot of people saying maybe we have a recession coming. Some people are saying things are different since there's been so much quantitative easing in all these years that bond math isn't the same. So I guess, Gemma, I'll come back to you.
Yeah.
How are you at Vanguard looking at this inverted yield curve, and what's your thoughts on recession or not?
Yeah, so our view this year had been that we would get growth slowing to 2%. Inflation would dip in the first part of the year, which is playing out pretty much, and then mean reverting towards target. So we just saw the Fed, you know, very content to be on hold while other central banks provided some stimulus. The yield curve would remain relatively flat, but not so much inverted. We've seen further inversion again in the last month. We saw some earlier in the year. The Fed managed to talk the market into pricing in a little bit of term premium in the back end, and now we're seeing it very inverted. Over the last 50 years, what we see that as a precursor to a recession within 5 to 18 months. That's not our central case scenario, but we see it's a growing probability right around 30 to 35%, which is pretty big, 12 months out. I think the catalyst to all of this, which Powell highlighted today, is trade and the downside risks to trade. And you know, the market's already priced Fed rate cuts, downturn in growth, but the market hasn't really priced in the short-term cyclical uptick in inflation that can actually re-steepen the curve temporarily. So trade tariffs would have a very big impact on inflation, and inflation expectations are the cheapest they've been since 2016. And so you would see some repricing of inflation risk in the near term. particularly since the Fed, in all likelihood, would not tilt against that increase in inflation at this juncture if growth is in fact slowing. So we have a central case of potentially more slowing. We give it a 60% probability that trade will linger with us and continue to act as a depressant. But I think the market hasn't really priced in the fact that just another 10% increase in China tariffs and 10% in Mexico tariffs would add at least another 0.5% to core PCE. Then if you did more than that, and trade continues to linger, then it's a nonlinear approach to short-term cyclical inflation.
So does that have you thinking, kind of the curve is going to ultimately steepen? I know you mentioned that, but you guys are positioning in some way for that eventually, not too far off, that's going to happen.
Well, the way you have to look at it is it's almost a win-win on the steepener at some level, because either inflation premium rises and then you have the Fed easing at the same time because of growth slowdowns, and that'll naturally give you a steeper curve. So either you get slightly more term premium in the back end and you get lower short-term rates and the curve would be steeper. Timing is always the issue, right? And that's the $64 question. When you look at the history, again, the curve really stays inverted until the first rate cuts. So, that's at least 6 months away from now, and then you could see a sharp steepening of the yield curve. Because at the zero lower bound, my general thesis is that the Fed, this close to it, the Fed will be very aggressive out of the gate if, in fact, you have a meaningful slowdown. It's not an insurance cut. It's not one cut or two cuts. But if you are entering a recession, the Fed will get out in front very quickly, very aggressively, because they don't have a lot of ammunition.
Right. So Marc, in your non-traditional fashion, can you bring something else to the table that Gemma didn't mention? Talk about what you think on if the inverted curve is signaling a recession, and how does that have you kind of positioning portfolio overall, not just where Treasury yields will go?
So a few things. One, it's not going to sound overly heroic to say that it's right to position for a steepener when the yield curve is flat or inverted, because it tends to be a short-lived phenomena, not extraordinarily sustainable. I agree with Gemma. I do think that an inverted yield curve is a troubling fundamental factor in the sense that the global economy is a levered economy, and levered economies grow or contract based upon credit creation, and credit creation is done or credit creation is formed or occurs when financial institutions can borrow short and lend long and do it profitably, and when the yield curve is inverted, you can do it less profitably. Or in fact, maybe it costs you a little bit to do it depending on how inverted the yield curve is. And so that slows credit creation, it slows the economy. To say whether or not it predicts a recession is less important. I mean, I think that it's quite possible that even if we slow to something close to a one handle on growth, it will feel pretty poor from an economic fundamental perspective very fast. And that will certainly have, particularly in the context of rather full, if not rich valuations, can have quite negative consequences for risk assets, whether it be equities or credit, high yield, or others. So an inverted yield curve does matter. In the near term, at least, the curve is inverting the good way, in the sense that it's not a hawkish mistake by the central bank raising short-term interest rates faster than longer-term interest rates are rising. It's actually longer-term interest rates declining relative to shorter-term interest rates. And that creates an interesting dynamic. To your question, Liz, about what do you do about it? Well, the cost of insuring a portfolio against more uncertain outcomes is lower than it's ever been. And so to shorten portfolios, to move from from equities that have a dividend yield below the yield of cash or short-term deposits seems to make some sense. And then finally, if you can find good alternative-oriented or liquid alternative products that are LIBOR-based, products, there are many out there that are LIBOR plus 2 or 3%. LIBOR plus 2 or 3%, well constructed with LIBOR at 2.5, is a 4.5 to 5.5% return, which is pretty competitive in this environment. So
and
there
in
are
that
things people
sector,
can do.
Marc, can I? Sorry to interrupt. Are there particular products you like, LIBOR-based? Because there's a lot, yeah. Or if you can't say, we understand.
I probably shouldn't talk about products. I'll probably veer away from that.
Okay,
Have
that's
a chat
good.
later.
Okay, tell me later. I've got a scoop. Katie, so we'll come to you, and I know you don't kind of predict where what the Fed will do, but how do you factor this curve into your mathematics here?
Let me give you an example. We don't predict where the Fed is going to go, and here's an example of today. The Fed comes out, and it's already priced in.
Right.
So you could have predicted it, but guess what? until the moment it comes out, it's not necessarily there. But what we're really looking at is what are the trends? What are we seeing? What's changed? And we're seeing three things right now that are a little bit concerning. One would be that we had very strong conviction in equities until March, but we've actually seen a lot of short signals and a lot of negative direction in equities. We've even seen a tilt towards negative views on EM. It's tough to say that today because obviously today the S&P is rallying pretty strongly. So we're seeing a lot of hesitance and weakness in equity markets, first of all. Second of all, we're also seeing this flight to safety has been very powerful. That means that especially long-term bonds, we're seeing major moves in the ultra 10-year, 30-year, and et cetera. And finally, and this is where the last week has been very interesting for us, is that we've seen this trade about the strong dollar has been thematic since last April. And this last week, we've seen some of the first weakness of the dollar versus the euro, which was pretty aggressive. And why that's interesting is because it could be the first indicator that what's going on with China and trade actually will affect the dollar, and that growth expectations might be lower going forward, although they were good up to now. And so that's something that really I focused on in the last week and have been following. So I think it's a really complicated problem because you have so many dynamics in a global modern economy that you, not just FX, but bonds and equities are all, let's not forget the commodities as well, are all really sort of working in very complicated ways. So
can I, are you kind of getting to it, you might have seen some inflection points in the last week that you're watching, you know?
So I'm watching that because we've really seen such a strong dollar. And if you think about it, the dollar relative to the other economies around the world, the US has been so much stronger. And what this indicates is to some extent is that there is an impact of trade and tariffs. And so I'm watching that a little bit more because I think those are all connected. Just one example, we've seen the same move. So it's always been equities down, bonds up, dollar up. But recently, this week, we saw the opposite yesterday, which was surprising to me, which was equities are down, bonds are up as a flight to safety, and the dollar is actually cooling off. So that would indicate that there's two forces pointing at the US economy weakness as opposed to one. And so that has been very interesting within the last week.
Okay, so we've touched a lot on the Fed and kind of their rate outlook, that cuts don't seem out of order. And I want to ask Gemma, but we don't have enough time. Like, what does an aggressive Fed mean, 50 basis points? But we'll leave that for later. But I want to get a little bit into our kind of, for those bond wonks here, and I know we can all speak to this, is one interesting thing that, you know, we've kind of talked about before is the Fed's balance sheet, which they have indicated that they're going to stop as of October unwinding it. But they haven't given all the clarity on the composition of the balance sheet. We do know that they're going to move, they want to get out of the MBS holding business, which they only got into after, you know, the Great Recession. So we know that. We don't know exactly what maturity structure they want to ultimately have for the portfolio. So I want to touch on that a little. And I know, Marc, we had chatted before that you said you see some, even in what we know now, what the Fed wants to do, some interesting relative value related to MBS securities, given what the Fed's going to do. So if you can touch on that a little.
Sure, happy to, Liz. I mean, you sort of touched on it a little bit in the sense that we do know that the Federal Reserve wants to slow their pace of balance sheet normalization. We don't really have a fulsome sense of the compositional, and so we understand the directional. We don't have a full and clear picture of the relative value. So the first point before we get to mortgages would be, you know, how will the Fed continue to reinvest across the maturity spectrum of Treasuries? Will they continue to invest pro rata across the outstanding issuance and stock, or will they decide to migrate back towards more of a pure balance sheet, which is just shorter term holdings? That obviously has really important implications for yield curve, probably more so for yield curve than directionality of interest rates at this point. So that's the first question or point about relative value, what really matters. And then the point to mortgages. Mortgages to us are pricing in quite a bit of concern regarding the potential, not just unwind of the balance sheet, but maybe even the potential for sale of mortgages out of the balance sheet, which could be quite negative. Mortgages, in our estimation, in the past few years have gone from quite rich, given Fed purchases, to actually quite cheap on a model basis. And so there seems to us to be a decent amount of bad news priced into mortgages at this point, but greater clarity, greater understanding about how the balance sheet, how the path of balance sheet transition will occur will have wide and sweeping relative value consequences across the bond market.
And Gemma, I'll pick up that with you. Like, we know the Fed doesn't own any bills now after Operation Twist. Do you have any thoughts on how they might, ultimately shape their portfolio duration?
So we have a little bit of an inkling from them in the last week where they said they would begin to reinvest into bills again. To Marc's point, we don't know what the final composition will be, but it looks like it's a pro rata purchase up to $20 billion a month. Certainly smaller than QE was, but the ongoing purchases will be there. I think the thing that we're focused in on is the contraction of the balance sheet has produced some illiquidity in the front end and money market rates from time to time, and we've seen 3 reductions on interest on excess reserves. So it'll be interesting to see what happens to the Fed's balance sheet and what the demand for liquidity will be going into the last quarter of the year once they stop their runoff and their reinvesting. And then how does that play forward? Does interest on excess reserves have to be reduced further? Does the Fed need to provide some kind of liquidity facility on top, a repo lending program that the market's been discussing? And net, where does it go into the second half of 2020 when they need to begin to expand their balance sheet again? So I would say the balance sheet will be with us for a while, but the main takeaway for me as an investor is, where is the liquidity in the funding markets? Is that liquidity satisfied? And does the Fed need to make further adjustments to short-term interest rates to kind of reverse that corridor, interest on excess reserves becoming the floor and some kind of repo facility on the top?
And are you leaning towards, because like you said, they've talked a lot about having this standing repo facility to help with what they're doing. Do you think that seems maybe likely that they do?
Again, it's an evolution. For now, the Fed is quite comfortable with being able to provide ample liquidity. But, that's been a moving target for the last year right now. So we'll have to see how it evolves. Clearly, some of the work that's been done and research been done inside the Fed suggests that, they've looked at it, reviewed it, and we'll have to see what that evolution will be. So I think the market's focused on that, and I think the market will be focused at what comes out of the conference on inflation targeting potentially that's going on today.
Right. And Katie, how does through time, like when the Fed started ramping up the balance sheet, obviously that factored in. Now we don't know exactly, like Gemma said, the feeling is that they're going to stop, and then eventually when they don't want reserves to be too scarce, they're going to increase the balance sheet again, only for like monetary policy reasons, but it's still going to remain large. Do you have any thoughts around how you're doing things around that?
So I think we look at what the Fed does ex post. We don't see it as an ex ante, like measurement type of thing, but we're definitely paying attention to what they're doing because they really do drive a lot of the movements that we're trying to follow. I think we're spending a little bit more time, like I said, looking more at how these markets are interplayed with others. And for us, we've seen that the Fed's decision today was already priced in. And you can see that in prices today, that basically yields went up a little bit today, which is surprising. But equity markets responded. And so we're keeping an eye on it. But, it's very hard to mathematically model the Fed. Yeah. If you have an idea, let's compare it.
The Fed's having trouble with its own models anyway. So we have a few minutes left, and I warned everyone that if we have a couple minutes, and I feel like it's like the Golden Globes or something, 4-minute warning. But to come to you guys and say, so maybe if each of you could speak for just like a minute, is there something we didn't talk about that you see as, either a big risk in markets or that's really on your radar that you think, everyone in the room should know? And I guess, Marc, I'll start with you.
Yeah, it probably, I suppose there's a couple things, and I'll be brief, and it probably sort of extends outside of rates and FX and maybe into more credit markets. Katie touched upon this a little bit, the changing nature of the relationship between equities and/or credit, rates, FX. And as you look at each individual country around the world or around the opportunity set, in a broad landscape, in a world that is vastly less liquid from a financial market perspective than it's been in the past, it's increasingly important to understand what the release valve is. And in some countries and in some markets, it's FX. In some countries and some markets, it's government bonds. In some countries and some markets, it's credit-related instruments. And being able to understand, again, in a much less liquid world, where that fulcrum security is, where that release valve is, that's, I think, an increasingly necessary skill set in defining the difference between investing success and failure going forward. So liquidity is one element that's quite concerning. And then the other would be just the degradation in credit quality generally, again, in the less liquid market. Increasing leverage in corporate credit, much higher degrees of lower rated credit, non-existence or the lack of existence of covenants or protections for bondholders more generally, in senior secured lending, in bank loans, loan-only capital structures where there's very little, if no unsecured debt below. And so in a world of narrow valuation and tight credit spreads, particularly in the traditional credit markets, the warning signs are beginning to be a little bit more concerning in terms of fundamental deterioration in the context of still quite tight spreads and narrow valuations. So liquidity and the general state of credit markets would be the two other areas that I'd focus on.
Great. And Gemma, if you have some thoughts?
Yeah, just on the heels of that, I mean, in the rates market or even in the rest of the fixed income market, illiquidity and episodes of very high volatility combined with low liquidity, like we saw in the fourth quarter, is something to be mindful of and watchful going forward, because it will exacerbate any particular move that you have. I think the other thing is we've become inured to low volatile periods, right? We've been in the post-financial crisis now for over 10 years, and we're just used to that framework. And there are many in the trading realm who don't see high volatile periods, really don't know how to react to it, doesn't know what it means, doesn't know when the correlations break down how you should react. And I think we could say that that's any type of risk asset. But when it happens in the U.S. government market, very similar to what had happened in the fourth quarter, particularly around the holiday period when balance sheets were constrained, I think it's really important to kind of think about how you want to position, even in a risk-free rate product, well in advance of any potential, bout of volatility. Because I think we'll go through waves of, high volatility, low volatility, high volatility, until we can figure out what the macroeconomic trend is.
Great, thanks. All right, Katie, you have under a minute. Pressure's on.
Pressure's on. I mean, I would be honest, if the thing that would scare me the most is rising rates, but there doesn't seem to be a lot of indications that that's going to be my concern. What I would probably dislike the most or find the most frightening was some of the environment we had last year, where one day everything is great and the next day everything is terrible. It seems that this year has been much more consensus-driven in that people are concerned, but they're concerned in some sort of consensus-oriented behavior, and we see that in prices. So volatility has behaved drastically differently this year, and diversification seems to be there in terms of other asset classes moving in, not in tandem, but in different directions. So I think that's what scares me the most, is if we started to see that type of back and forth that we saw last year, this sort of bimodal volatility. I'm fine with volatility, but back and forth volatility is very challenging.
Great. Well, thank you, everyone. I've found it quite informative myself, so thanks for having us, and I think we're at our time now.